This is a quick tutorial to run you through adjustments. Remember, the purpose of adjustments is to account for ledger accounts that have been impacted but we haven't made a journal transaction for. So for example, we'll run through these and you'll kind of see how they work. So the first one here, we have adjustment, unused supplies on hand, $250. So what that's saying is that we have $250 worth of supplies left over at the end of the period. And if we look up here, we started off with $3,670 worth of supplies. So since we have $250 left, we have to adjust that ledger account, the supplies account. So the supplies account needs to go down, so we need to credit the supplies account. And remember, whenever we use up an asset, the resulting debit is an expense. And in this case, we have supplies expense. So if we go to the key here, you're going to see supplies expense, and there's the debit for $3,420, and then we lower the supplies account, we credit it by $3,420, and we get that by taking the beginning balance right here and we subtract the amount left over. So whenever we have an unused and it's giving us that ending amount, that is when we calculate the difference. Alright, the next one, we are also using up an asset. In this case, it is our building. And remember, our long-term assets, we do not adjust the long-term account, we adjust the AD account, the accumulated depreciation, the contra asset account. So this number, it says, hey, listen, we're using up $3,840 of the assets, so that's the depreciation expense, and then accumulated depreciation is the credit. So we've done these in class. Here's the entry right here, depreciation expense, AD. C is kind of the same thing. It walks you through the depreciation expense in AD. I'm not going to run through that one right now, but you can kind of look at the problem here. It's the same thing as B. So C, depreciation expense, accumulated depreciation equipment would be the credit. All right, D, unearned fees still unearned. So how much of our unearned fees have we still not earned? And the account should read 1,000. So if we come up here and if we look, the unearned fee, the liability is at $3,360. So we need to get that to 1,000. So therefore, we're calculating that difference. So the debit is the unearned fees account because we're wiping away that liability, and now we're recognizing the revenue has taken place. So the revenue in this case is fees earned. I'm just pulling that from up here. So if we look, we're going to have the debit to unearned fees, and there's fees earned as the credit. So now the revenue has been recognized for that one. E, we have salaries earned but not yet paid. So our workers worked for the time frame, we haven't yet paid them, and now we're paying them. Or we're not paying them, but they've earned it and we haven't paid them. So we have a salary expense, and then we're creating a liability here where you owe them the money, and that's the salary liability. So you can see here, well, in this case I called it wage expense, wage payable, same thing. So there's the wage expense, and then there's the creation of a liability. The next one we have is interest expense, interest payable. So basically we're accruing interest on the note, and there's the entry. We're accruing interest on the note, we have interest expense, interest payable, $430, that's off. So that is another type of entry. Remember, we have these notes, we borrow money, we talked a lot about this. You borrow money from someone, even though you're not making that payment, you're still accruing that interest. Okay, so there's the interest expense, there's the interest payable. The last one here we have, I'm just going to look at the entry, see if I can explain it. So we have accounts receivable and fees earned. It looks like we forgot to record a revenue is my guess. That's going to be my guess. Let's go back and look at the entry. The entry says fees earned but not recorded, not received. So we forgot to record a revenue transaction. So there is the receivables, the debit, and the revenue is the credit. So there is a quick problem for you to look at. Please, go over those problems. You have about 4 or 5 adjustment problems. Like I said, on this module exam, students struggle with the adjustments mostly because they're not confident in their journalizing, which you should be there by now. So now you need to dominate these adjustments. And remember, when you're using up an asset, when you're lowering an asset account, you're always going to have a resulting expense here. So you can see just by looking at the key, asset going down, there's an expense. Asset going down, there's the expense, right? And so those are examples of that. This is recording a revenue we forgot about. This is creating a payable. We've incurred an expense, and since we're not paying with cash, we've paid off where we owe them, and we create a liability for that one. Same thing here. We didn't pay that payment, and so therefore we still have that expense, and we create a liability there. So these two are very similar in conceptually. All right, so take a look at these, and good luck studying.